So, I would like to continue with my previous discussion on the oncoming market crash that's worse than 2007 and 2008. And in this video, I would like to add that gold is not going to be your safe haven asset during this crash because there's an equally strong buy signal on the inverse ETF for gold, and you can see that on this chart right here. And so, for the economy that's going forward, I would like to bring up five different scenarios of how it will play out. The first one is a liquidity crisis where everybody would sell all their assets into cash because in a liquidity crisis, people would prefer liquidity in their assets over their safety. So, we have seen this during the 2008 financial crisis and the COVID crash that happened in March of 2020. And the second scenario is a strong dollar and high interest rate environment. So gold is priced in the US dollar. So in a strong dollar and a high treasury yield environment, gold prices would often fall. And in a high interest rate environment, it's harder for companies to raise debt. And so their company valuation would fall. So we have seen this during the late part of 2022, where the Fed was having a tightening policy, which hurt stocks and gold. And the third scenario would be a deflationary scenario where company earnings would fall and thus would their stock prices. And so in a deflationary environment, generally prices would fall, thus making the real value of holding cash rise, thus making gold a less attractive investment. And we have seen this during the Great Depression in the 1930s. And the fourth scenario would be a straight restriction on the transaction of gold. And we see this as a less likely scenario to happen. The last scenario would be a supercharged economy with high growth in our GDP, which we haven't seen happen yet. But in this scenario, stock prices would correct due to overheat, which we have seen lately in our market. But they would correct after this overheating and inflation, and gold prices would fall as well because why hold gold when there is more attractive investments elsewhere due to the supercharging economy? So I hope this breaks down the different scenarios. So let me know which one fits your judgment better.